Hey everyone, welcome to In the Money with Amber Kanwar. Can you hear the excitement in my voice? We are back with season 2. I think this is our 64th episode. I am so excited. We've got a brand new set, if you can't tell. Obviously, if you're listening on audio, you definitely can't tell. But if you're watching on YouTube, you can see new digs, a new table. We've got our EBITDA sweatshirts, and we've got all new swag. Finally, after 7 months, I got in the money hats, thanks to our partners at Raymond James. If you got a couple extra 100,000 kicking around, give them a call. They'd love to manage it for you. They're helping us with all of our swag. And you know what? Once again, I have too much of it and I want to give it to you. We are doing our swag giveaway all month. And it's so easy. Probably the easiest thing you will do in September. All you have to do is subscribe wherever you are listening and comment wherever you are listening. And we will reach out to one viewer or listener every single episode. And you can pick, do you want this in the money hat? I also have EBITDA hats. I have this girls just want to have funds cup, which is my favorite one, to be honest. And we also have, of course, our classic in the money mugs, all thanks to Raymond James. So subscribe, comment. It is so easy. And honestly, this is a really easy podcast to subscribe to, because this month we are starting season 2 with a bang. Our next episode, we have Adam Waterous on the show, the CEO of Strathcona, which is in hot pursuit of Meg Energy. They've got a hostile offer on the table, which, by the way, they just increased. So the stakes have never been higher. Are they going to come away with it? What happens if they don't come away with it? Why do they want it so badly? Adam Waterous will be back on the podcast for an in-depth interview on Thursday. But today's episode is cannot miss, especially with the markets at record highs. It seems like everything is awesome. Well, according to Larry McDonald of Bear Trap's report, maybe not. It's really not about being bullish or bearish, but it's being positioned correctly. He does not think the Mag 7 is what takes you forward. He is a big proponent of moving into hard assets. He is a very well-known strategist on Bay Street and Wall Street. He came out of Lehman Brothers writing kind of the historical perspective of what went wrong there, I should say. So it's a fascinating conversation about the shift that is happening in markets. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Larry McDonald of the Bear Traps Report, thank you so much for joining me.
Amber, thank you. I love the platform. Nice to be part of it.
I'm so excited to dig in with you for the next hour, because it's not really just to say you're of the Bear Traps Report. You are so well known on Wall Street and Bay Street, coming out of the financial crisis as a Lehman Brothers proprietary trader. You write this book that really becomes almost a history book of what happened with Lehman Brothers. You write The Colossal Failure of Common Sense, an inside story of the collapse of Lehman Brothers. And that goes on to become the foundation for sort of your next act. And you do have a new book out, How to Listen When Markets Speak. But I want to first start with that as your origin story. The Lehman moment, it meant something for the financial markets, but it also meant something for you professionally, right? Like it totally altered where you are or where you were going to take your career.
Yeah, thank you, Amber. Yeah, it was tough. I mean, you work so hard, all those hours in the office at 6 o'clock every morning for all those years. And Lehman was never rotten at the core. That's where all the beauty was. She was really rotten at the head. And that hubris, that mismanagement is something that, we see in companies from time to time. We see in politicians from time to time. Hubris is a very dangerous and deadly word.
I mean, and we look at the markets today, there's no shortage of that. And we're going to talk about it. But I want to talk about how that changed your view as an investor. Like, what kind of investor were you before? Were you always inclined to think about these risks as deeply? Or having lived through it, like, what do you take with you every day because of the experience, because of the extensive research you did on that first book, which is a New York Times bestseller?
Well, in the years after, there were a lot of Lehman-like situations like the Greece crisis where sovereign bonds in Europe were really blowing out. But what I'm most proud of is in our new book, Neil Ferguson does the kickoff, the forward, and he's like, listen, Larry, some people call Larry like this bearish type guy, but the concept of our new book is really not about bullish or bearish. It's about a colossal multi-trillion dollar migration of capital from financial assets to hard assets. And if you think about it, the Lehman fiscal and monetary response, Amber, the fiscal and monetary response to Lehman Brothers was $4 trillion. The fiscal and monetary response to COVID, the regional bank crisis in 2023, and a lot of the fiscal spending in recent years has gone up to about 16 trillion. So think of 4 trillion versus 16, 4 trillion versus 16. Because of that colossal fiscal and monetary response in recent years, that is triggering sustained inflation, sustained bond yields at a higher place, and that's triggering a colossal historic migration of capital from financial assets to hard assets.
I mean, let's underline that 4 trillion was huge at the time, biggest ever. And now with retrospect, it almost looks cute, right? It's like, oh, you threw 4 trillion at that problem. And yet, and I love what you said, people say, are you a perma bear? Because one thing we did out of that financial crisis is we lionized those people who got it right, who called housing. Ultimately, though, even if you totally didn't see the financial crisis coming, if you just held on, if you're a long-term investor with a long-term view, if you just held on, time ultimately rewards you. And so bearish stuff gets a lot of play, right? Even I see it.
Yeah.
The bearish stuff that I do gets more clicks than the bullish stuff than I do. Tom Lee still faces, hate for just being this bull, but honestly, he's been right about it. How do you think about the value of being entrenched as a bear or even a bull?
Well, what I love is like the gold miners and the silver miners and the copper miners are absolutely destroying Mag 7 this year. Even over the last 2-3 years, Agnico Eagle Mines is destroying Microsoft. I mean, Nvidia is being destroyed, absolutely destroyed by the gold miners. And so, yeah, you can be kind of like bearish on certain things, but as long as you're kind of making a bullish call, there's always a bull market somewhere, right? And so we're looking at really kind of the better risk reward, right? So think of like Nvidia, $4 trillion in Nvidia, 4.1 trillion, and as of like maybe 2-3 months ago, all the gold miners combined were maybe $250 billion. So it's 4 trillion versus 250 billion. And so there's a lot of places to be bullish.
So your overarching theme, and we're getting to it, migration to hard assets, longer term inflation is sticking with us. But I just think about Just like an everyday person, if you think about what is our life going to be defined by in the next 5 years, it's not going to be defined by gold and silver miners, which are cyclical, and ultimately the things that they extract have no productive value. I'm using AI every single day, and every single day I am blown away by how much easier my life is, how much lower cost things are, because instead of paying for some of the services that I ask, ChatGPT or Grok to do, I'm getting like fairly decent results. And I'm sure you're using AI too. So doesn't that stand to reason in the next 5 years, like what's our world going to be shaped by? It's AI. Shouldn't I be investing there?
Yes. The problem is it's much like 2000, and we saw two examples of this: 2000, say 2000 to 2003, 4, 5, and then we saw from 2010 to 2014. In 2000, everyone was invested in the same obvious thing. Everyone was along Cisco, Global Crossing, and they were all kind of crammed into the same picture, and that created enormous kind of like tremendous risk. But the Facebooks of the world, the Googles of the world back then, the Match.coms of the world, nobody was invested in these things, right? Same thing with the shale revolution. You had everyone was invested in natural gas equities and oil and gas equities from 2010 to 2014. It was the most crowded trade, and the whole thing blew up because everyone basically was in the same trade. If you look today, the NUKZ ETF, which is a basket of AI infrastructure names that we've been a part of for the last they're all in our new book, How to Listen to Market Speak. But AI infrastructure for the power grid, we have a power grid in the United States that's 50 years old in some spots, 30 years old in others. Okay. The growth estimates on Wall Street for AI companies like Nvidia are complete baloney. They're garbage without a real infrastructure for energy. And unfortunately, the equity analysts, they're just looking at AI and Nvidia and chips. They're not looking at the power. And that's where the money is. And that's the NUKZ ETF is destroying the Mag 7 this year and even over the last year. The NUKZ, look at that portfolio of companies in there, your Vistras, your Constellations, your uranium names, all
Cameco.
nuclear power. That's the key to the future.
Yeah, so that ticker nukes. So that gives you a sense of what it is. Yeah, Cameco, Constellation, GE Vernova, New Scale Power. So all of these names in this ETF. And yet, so how do I reconcile? Because on one hand, it sounds like you're saying these AI names, pure play, the ones actually making the investment are overplayed. Are you saying look at where they're deploying those dollars? Those are real dollars. So the whole AI trade is not a house of cards. It's just like maybe you need to be looking at a different part of the spending cycle.
Yes. So look at the last week, Mr. Zuckerberg was in the White House with President Trump. He's promising another 650 billion of investments, right? And so that investment trajectory of all these AI companies, it just doesn't make sense unless you have a whole energy infrastructure to support it. In other words, you just can't create all these data centers that are going to overwhelm. Just look at electricity prices. They're going up like literally a vertical. I mean, this is going to crush middle class families across the United States. The political backlash to AI data centers could be spectacular because, once again, that power grid needs, Amber, we need a $2 trillion revamp of the power grid to support all these data centers. So what's going to happen is these companies are going to be forced by political pressure to bring in local power, to bring in uranium power, nuclear power on site, natural gas power on site. They're going to be forced because they're overwhelming the grid and they're overwhelming the U.S. utility companies.
So let me throw in a risk out there, since you love to look at risks. Is what about the risk that we find a cheaper way to do it? That it doesn't actually need $600 billion. And I think that's what the DeepSeek freakout was all about, right?
Right.
Is that the chips that were required, they were lower grade, required less power intensity. Like, wouldn't all of these companies prefer to do things a cheaper way? And eventually they'll find out because they can't, Facebook, even if that is the number, they can't keep spending like that. They don't want to be spending like that. So eventually they're going to find a cheaper way to do it. And doesn't that mean that all of these commodities that you're building the trade on are vulnerable?
Yes. When we had the DeepSeek scare, you're absolutely right. The high beta stocks in the NUKZ got hurt for sure. But remember, just on valuations alone, the if you just look at the say Microsoft, Meta, and say Nvidia, you can't have two stocks. Think about this. There's two stocks that are now 15% of the S&P 500, Microsoft and Nvidia. Two stocks. I'm going to repeat. Two stocks are 15% of the S&P 500. This statistic was over the last 30 years. The average for the top two names was a 7 to 8% of the S&P. So to us, if there is kind of a big problem with CapEx, you have long-term a lot more downside in Mag 7 type stocks than you do in that energy infrastructure. There will be a shock where everything gets hurt, but companies that are, you can't have two AI companies that are 15% of the S&P 500. Jack Bogle would be rolling over in his grave right now, the founder of the S&P indexing.
So those two stocks are Nvidia and Microsoft. But these are not like, let's go back to 2000. You're saying like in 2000, that was obviously, the internet was booming, but there was a tech collapse. And so a lot of people will say, well, the same thing could happen. AI will be a thing, but doesn't mean that those AI stocks are going to do well. These companies, though, they're not startups.
Right.
Microsoft was part of that collapse in 2000. Microsoft has so many other business lines that have nothing to do with AI. They are cashed up behemoths. And, they're trading they're expensive, but they're delivering on their growth. Like, these are not a class of 2000 stocks. What do you say to that?
Okay, that's true, but it's very, very, very backward looking. Remember, like you said, Amber, you're nailing it. These have been cash cows, tremendous cash cows. But now it's just like 2000 and 2014. And it reminds me of the natural gas space, and it reminds me of Global Crossing, because you've got cash cows that have become extremely capital intensive. In other words, if you just look at what they're spending on CapEx, that's going to crush earnings in the coming 2 to 3 years unless there's a return on invested capital, right? So it's kind of like they're building the stadium. They're saying, we'll build it, they will come, but there's very little visibility on return on invested capital. So when you have $2 trillion of capex, in the old days, that $2 trillion would be on the company balance sheets buying back stock, right? To your point, because they were cash cows. But now you've got these cash cows that are becoming extremely, violently capital intensive businesses. And unless we see a return on invested capital in the coming years, earnings are going to collapse for these big investors in what we call the hyperscalers.
Honestly, forget about my pushback. Who cares about the arguments that I can come up with? Because you've got clients who are real market makers, right? Like, you've got the ear of billionaire hedge fund managers around the world. So you're going around this year, you're going around 2025, and you're telling people this is what's going to happen. These are the signals that we're getting. What do you hear back? What's the pushback? Is this what the smart money already is doing? Or, does it take some convincing for people to wean off of their addiction of Mag 7?
Yeah, so exactly. So Larry McDonald, I'm a former pork chop salesman that was very successful with two books. But over the years, through the speaking tour, we have built an incredible reservoir of talent behind me. So we do ideas dinners. We just got back from the West Coast, Menlo Park, ideas lunch, ideas dinners in San Francisco. We have the largest platform of institutional investors on a regular basis holding that buy side conversation. And what I can tell you is we have people in our Bloomberg chat and in our Discord room and at the dinners that we've been hosting all around the country in New York. And like I said, in San Francisco, LA, and Beverly Hills about 3 weeks ago, the institutional investors that we see were pounding the table bullish on, say, Nvidia and Meta and Microsoft. Now, a number of them that have made large profits are now turning bearish on Mag 7. And so that to me is the most interesting thing. This isn't about perma bulls and perma bears. This is about real bulls that have made a lot of money, but they're very uncomfortable with the return on invested capital outlook.
And that's why. That's the underlying factor that's
Yes,
made them go bearish.
and the big thing is, so if you listen to Jensen and Nvidia, he's the real pump master. Remember, Jensen has blown up investors twice with 65% drawdowns in 2022 and 2018. He's just really hurt a lot of investors. Now he's made, like to your point, if you just bought Nvidia and held it and never sold it, you made a lot of money. But it's very hard for a young couple that's in a momentum stock. They're going to buy a house and they see their $1 million investment go down to 250,000. It's very hard to hold that. It's very hard. Same thing with Bitcoin. And so it's about this, it's about the large investments, it's about the drawdowns, but at the end of the day, it's about the energy bottlenecks. The biggest risk is that the growth assumptions for AI, for Nvidia, for all these stocks, Microsoft, if you have energy bottlenecks around the United States where we can't get the power in the right locations to the right data centers, then all these growth assumptions blow up. And that is, I think, that's from what I am hearing, that is what's about to happen. We just don't have the energy infrastructure to support the growth.
And is that agnostic of what happens with monetary policy? We're sitting on the cusp of rate decision in the US where now it's widely expected. The debate isn't, are they going to cut? It's 25 or 50 basis points, widely expected, at least that 25 basis point cut because employment is falling apart. But you've got this view on inflation remaining high and elevated. So talk to me about, that landscape, the monetary policy landscape.
So to your point, yeah, we're essentially easing now into what we call core CPI or super core or core at very, very high levels. I mean, we're easing into the highest level of core CPI or super core that we've seen since the 80s. And that's pretty wacky. You've got ISM prices paid. If you look at the rate of change, Amber, of ISM prices paid, which is a great forecast on the future potentially of tariffs, once again, you get a vertical move. And if you look at Philly Fed prices paid, Richmond Fed prices paid, you really have some tariff inflation out there, or just inflation from reshoring. You can't just like reshore all these jobs to America and not expect inflation, right? So there's all these secular changes in inflation. And so if the Fed has to reverse their very, very dovish policy, that's one thing, that's a shock. But above all, that dovish policy is creating this, what I call this Manhattan Project. Like you think about, this is like a Manhattan Project where in the Valley, these guys, it's like a testosterone overdose. They've got testosterone going into their veins with needles. They're all trying to outspend each other because, like you said, we have relatively easy money now, right? And so people are spending money on the capital expenditures in Silicon Valley, these Mag 7 hyperscalers, as if, there's really no caution to the wind, because at the end of the day, they're terrified. They want to be first and they're determined. It's just like the Manhattan Project and coming out, toward the end of World War II with the nuclear bomb.
And this goes back to your origin story, like rotten to the core or rotten at the head. You've got spidey senses for like mismanagement. And is that going off? To what degree is that going off when it comes to that tech spending, that Manhattan Project around AI?
Well, that's what we're looking for. Like what I'm hearing in the chat, like just look at Meta. When you make this kind of a move from real capital, preservation and returning capital to shareholders through buybacks, and you go in a very short period of time to more capital spending, and then that capital spending doesn't to generate profits right away, that's where you get some funny moves on the accounting. We saw this with a lot of the natural gas names, 2010 to 2014. We saw this obviously after the dot-com period. And so what happens is in the early stage of capital investments, so say you're a hyperscaler, say you're Meta, you can make these large investments, but you don't have to show the returns right away because you have depreciation. But over time, we think, and we're already starting to hear this from the best institutional investors in our Bloomberg chat, people are very concerned about Meta's accounting now and the path that it's on and the spending. And so eventually we think we're going to have an accounting problem inside of one of these companies. It's very hard to say which one, but all the handwriting's on the wall, and it's all about hubris. And that hubris is kind of like over investing without really the proper plan.
And again, these aren't product problems. Like, ask any of your kids. They're addicted to their phones. They're addicted to these platforms. But that doesn't mean you can't see a drawdown because of a combination of valuation and maybe hubris on the spending. What kind of drawdown do you think investors could be bracing for, just given the run-up? How much has been built in? How much air you think has gone into these stocks?
Well, I hate to pick on Meta, right? But we're talking about a guy, Mark Zuckerberg, who blew up investors on the metaverse. He changed the name of the company from Facebook to Meta, and they lost like $4.5 billion on capital expenditures in the metaverse. Like, what happened? Now, all of a sudden, they've dropped that kind of, and they're more focused on artificial intelligence. Well, good. But we're still talking about a 70% drawdown in Meta equity in, say, I think it was 2001 to 2002. I think it was 65-70%. And same thing with Nvidia, it was 65-70%. So yeah, so you have that kind of drawdown? Absolutely. We just had one in 2022. So the probability of that happening again with these investments, I think is very high.
I'm going to go back to what you just said. So I think you were saying 2021 to 2022, we saw that 70% drawdown in Meta. You're seriously thinking that, with rate cuts, with their core business doing very well, there's no slowdown there. AI is actually bearing fruit at Meta. You still wouldn't be surprised to see that kind of drawdown.
No, because so remember, in the metaverse gamble, that's what it is, the testosterone metaverse investment scheme, they lost $4.5 billion. He just told President Trump last week he's going to invest another $600 billion in the coming years. So the bet they're making on AI, it makes the metaverse look like a complete joke, And so, I just think that it's the cart before the horse. They should be investing, and they are starting. If you look at the Wolf News, WULF, with say Microsoft, and Meta is now transitioning. Meta's making some natural gas investments. So we are seeing this, but just look at SMR, small modular reactors, right? So we recommended this equity to the Bear Traps clients, our Bear Trap support clients, a year and a half ago, because of the need to get small modular reactors on site. And you're seeing SMR get some deals with the hyperscalers, right? This is the key, because you're going to need that power, Amber, on site. These companies can't suck off the power grid because the power grid's too old, and they're going to also just drive up electricity prices. So my point is, this SMR equity has made this big move, but guess what? All the research we have from all of our analysts, they're not going to be able to get the power on site for another 2, 3, 4 years. And so it's a great idea, and it's a Band-Aid, but it's a Band-Aid out in the future.
And who knows if that $600 billion that he said was even real, because he was caught like sort of on a hot mic saying, "Oh, I just kind of like picked out a number." But it speaks to another thing that I would love to talk to you about is like that press conference, whatever you want to call it, with all those tech CEOs was kind of insane for another reason. It was just so much prostrating for President Trump, and just, saying 100 billion here, several hundred billion there. And it really seems like, especially as a Canadian, right? We're looking at the situation, it's Trump's way or the highway. And Canada is feeling that right now because we've got tariffs slapped on us, and we're having a tough time finding our way out of that. But that's also becoming true with monetary policy, right? You've got a president openly attacking the Fed members and the head of the Federal Reserve calling for rate cuts. You have Ken Griffin, who did an op-ed in the Wall Street Journal saying that this is eroding our institutional credibility. This is a risk. So let's apply that filter that you have of hubris, mismanagement, and apply that to this situation, and whether how investors should think about the risk of, not seeing a separation between church and state, the government and monetary policy.
So the White House is nervous. The midterms are 1 year and 2 months away. 1 year and 2 months away. And interest on the debt, Amber, is 1.1, maybe 1.2 trillion. Think about that. That's up 400% since 2021. So 1.1, 1.2 trillion. So I think what's happening is the White House, they know they got to get some rate cuts to keep the economy, at least they think to keep the economy strong, because the economy is slowing. But also they want to get interest rates down on the front end, because that will, if they get rates down on the front end, so it's T-bills and 1 year notes and anything inside of 1 year, then they can potentially issue paper in the front end and save some money on interest, right? But they risk a real big backlash, because every time the Fed has kind of eased since 2020, 21, because there's so much embedded inflation in the system through a whole bunch of different reasons. A couple of years ago, we were sending people money into their bank accounts, right? So all of that kind of sticky inflation is still out there. So now, if you ease too aggressively relative to the rest of the world, it really could create a 1970s stagflation situation. I think that's what gold is telling you. Why is gold just like the last thing about Nvidia since last November? Nvidia's up about 7%, maybe 7.5, 8. Gold's up 55%. So hard assets are destroying financial assets. And I think it's because of that encroaching stagflation risk.
And do you see that actually happening? Like, what probability would you put that the U.S. is heading for a stagflationary environment?
Well, we already are there in terms of this. It's very important that you measure stagflation. So we are not anywhere near a 1970 stagflation. On a scale of 1 to 10 would have been 10 being the worst. Okay. And that's where you had real unemployment and inflation running, upwards of 8% with real unemployment. So that's stagflation, where you're slowing the economy down and there's inflation at the same time. Say 2019, 2020, that's where stagflation was at a zero, right? We had no inflation at all. And we had some slowing growth in 2020 because of the COVID, but 2019, we had decent growth and no inflation at all. So that's a zero. Right now, we're probably at a 4, but we're moving towards a 5 pretty fast. And same thing with the rest of the world. Duration, look at UK 30 years, look at France 30-year bonds, right? All these countries, look at Japan 30-year bond. All these yields are breaking out because no one's made money, Amber. Nobody's made money on duration. So long-term bonds, everyone's losing money since 2022. Think of that. That's one of the most important parts of this discussion. Think of that. Since we're talking about going on 4 years, where trillions of dollars are invested in long duration assets, bonds, and everyone's losing money. Everyone. And what that does, and that's what creates that kind of move toward hard assets, because people are just really in a lot of pain on duration.
I'm glad that you brought up government debt, because that is something that people look at this number and they say it's so huge. And it's one of those things where you can look and say, it's too big, the interest payments are too high, there's going to be an accident. But people have been saying that for years. And then there just is no accident. And then the US 10-year goes up to 5%. And we're like, this is it. The bond vigilantes are coming in. And then it just goes right back down. And they go back into hiding. So how do you think about when the U.S. debt situation becomes an actionable accident?
Okay, well, let's just look at, just for some math. Apple did a bond issue in 2020-ish, 2021. It was a $2 billion bond, and they sold it at 100 or par. And it was a 2.55% coupon that was out to say 2060. So it was a long-term bond. So 2.55 out to 2060. That bond recently was trading at 55 cents, Amber, on the dollar. 50. This is backed by Apple. So this isn't like bond vigilantes are boo, 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 or like staring to scare. This is a mathematical fact. The $2 billion bond that was issued at par is now worth a little bit more than $1 billion. Like, that's a mathematical fact, historical fact. Now, rates have come down, at least in the United States. Right now, we're still back near the highs in the UK and in France. And think of all those bonds that are losing money. So no one can time it exactly, but we do have a situation. I think that's what's driving. Look at Hecla Mining today. Look at the silver miners. Hecla's up 9% today. These silver miners are up 50, 80% on the year, some of them, right? 80%. So something's going on with this duration and these bond vigilantes, and it's moving money into hard assets.
I think, take a step back, and you can almost see this all playing out in front of you. And it's sort of, it reminds me of kind of like the Biden administration. People were asking, why does the market keep going up? Why does the market keep going up? And, not enough people were talking about all the fiscal spending. Yes, monetary policy remained restrictive, but not enough people were looking at the fiscal or talking about it. And so now you take a step back and you can see what, to your point about the book is, what are the markets telling you when mining is outperforming the tech stocks? When the bond market has these little tantrums, I guess it is kind of like confirming this narrative that you're talking about. It's not just like you predicting it, it's you watching these markets and what they're trying to tell you.
Yes, and remember, Amber, they're so tiny. So look at platinum and palladium. Look at Impala Platinum or Sibanye Stillwater. But all the platinum and palladium ever mined in the history of the world, or the market cap of all that platinum and palladium, is only like $290 billion, right? So the gold market is upwards of, say, 20 trillion. So the gold is like your big, huge pool of liquidity in metals, right? But you've got metals like silver. The silver is still, I think, 10, 15% below its 2011 highs. It's only a $1.7 trillion market. Like I said, platinum and palladium are $300 billion, I think, combined. So it doesn't take much. Like literally, if right now there's 28 trillion in the NASDAQ 100, 28 trillion in the NASDAQ 100. It doesn't take much. If 2 or 3 or 4 trillion bucks moves out of financial assets, and we're already seeing that to your point around bonds. So people that own French bonds or UK bonds or US 30 years, they're already moving into hard assets. But if if money moves out of the NASDAQ 100, it just doesn't take much to double or triple some of these metal silos.
And where is the U.S. in all of this? Because again, listening when markets talk, gold is up, the U.S. dollar just can't seem to get a bid. That happens at different points in history, but is it a signal of something else? When you look at the tariffs, when you look at the reshoring, when you look at allies shifting, decades-long allyship shifting, what is all of that telling us?
Well, most important around tariffs and allies is that when you're raising it so far, they've raised about $350 billion on a run rate of tariff revenue, right? So $350 billion, that's a tax hike. Now, there's a lot of debate. This weekend, the Treasury Secretary Bissett was on one of the talk shows. He's basically debating Goldman Sachs as to who's paying this. Is it the Chinese? Is it the U.S. consumer? Are it companies? The bottom line is this tariff revenue has just come in recent months. And the probability that hurts inflation and or profits or margins is extremely high, because you just can't hike taxes, which are tariffs, by 350 billion in a short period of time. That's going to play out over the next 9 months. And so what we think is going to happen is you get this kind of slowdown, you get profit margin compression at the same time with more sticky inflation. That is very stagflationary. And once again, that moves money toward commodities, right? It's not just about the stock market. The commodity ratio versus the S&P is still at one of the lowest levels in the last 20, 30 years.
All right, let's dip into the mailbag because we've got a lot of questions. Some of them, pick up on tangents that we've already discussed, but we'd love to get the viewers' participation. They've always got an interesting angle. So let's see what we've got here in the mailbag. You talk about this shift to hard assets. We got a question from James on Instagram. We haven't even talked about copper. You've mentioned every single metal except copper. James on Instagram wants to know, where do you see copper going in the next 1 to 3 years?
Okay, so if you look around the world, the political pushback to copper mines, there's a copper mine in Panama, Amber, that's controlled by First Quantum, a Canadian company. And it's one of the most beautiful copper mines in the world in the sense that you can get copper into the ocean, out of the ground, into the ocean in a very short period of time. It's like one of the most profitable copper mines on Earth. It was shut down in recent years by the government of Panama, and First Quantum Equity got hammered. Um, Same thing in Chile and Peru. So if you look at Panama, Chile, and Peru, you're talking 45% of global copper production. Think of this: robotics, right? Every analyst on Wall Street wants to talk about quantum computing and robotics. No one's doing the math. If you just do a little bit of research, the copper that will be needed for just 2 million robots, 2 million robots, which is a fraction of what we are told they're going to build, right? They're supposed to build hundreds, 100 million robots over the next 10 years. 2 million robots is roughly 2 to 3 weeks of global copper production. There's a lot of copper, a lot of rare earths, a lot of specialty metals that are going to be in robotics. If you're going to have all these robots replacing humans, you're going to need a lot more copper. The COPX ETF is destroying the NASDAQ 100 this year. But more importantly, it's breaking out of a long-term downtrend. So if you think of like MACD or the way to measure kind of capitulation, you're talking about a multi-year bear market copper miners versus the Qs, the NASDAQ 100. If you just picture your mind of a chart here, you're breaking out of a long-term downtrend, extremely bullish for global copper prices.
So there's a question. You mentioned all these equities, like you can be bullish copper and do nothing with the equities. How do you think about whether you should be buying physical copper or whether, and there's a bunch of instruments to do that, or do you buy copper miners?
Okay, so what we do, one simple way is just look at the ratio of the copper miners to copper, right? And in recent years, just look at the gold space. We talk about this in our book, How to Listen to Market Speak. Gold was crushing the gold miners in recent years, even as of like 9 months ago. What happens in the early stages, Amber, of a bull market, people hide out. They hide out in the mothership, the commodity, right? That's what they do. And that's what happened with gold. Gold was destroying the gold miners a year ago, even 9 months ago. But as the bull market matures, the equities like the GDX is now destroying, the NASDAQ is destroying gold. And so at the first stage, people move into the commodity. And as the bull market matures, you move into the companies.
It's so funny you mentioned that. We actually did an interview with Ross Beatty in the summer, who's the CEO of Equinox Gold. And that's kind of an interesting situation. We got a question about Equinox Gold actually in the mailbag, where what do you do with like a laggard? So find gold mining stocks start to outperform, but then a few, because of operational issues, are left behind. Equinox, since it started to prove its way mid-August, has like exploded to the upside. And we got a question about, do you like those laggards? Do you look at the ones that aren't participating in the mining rally? And I'm curious, did you look at Equinox Gold in particular?
Yes. So what we do is we measure the GLD versus the GDX, right? And so you can track that on Bloomberg. We've been writing about that, and we talk about this in our book. Um, what we try to do is buy the junior miners. Once the GDX starts to outperform gold, that's where you really want to start looking at the juniors. And we've started to see the junior miners really, like the GDXJ, dramatically start outperforming. Same thing with the junior silver miners. That's a great place to be right now because you're in the early innings of this with silver. potentially a nice 2 to 3 year run ahead of us. And so, yeah, you want to start watching the movement in the commodity from the commodity to the miners and then the juniors. And that's where when you get into a real risk on bull market with a lot of tourists coming in off the bus, imagine, picture in your mind the heavy set guy with the Hawaiian shirt and the camera. That's the kind of the new tourists that are going to come in to the junior miners. But it takes a real mature bull market to really bring in that hot money into the juniors.
We got a question on Foran Mining, which is backed by Pierre Lassonde from Cardi on X. Another one of those examples that kind of lagged over the past year, but has popped recently as it seems like the juniors are starting to outperform. Is that one on your radar at all?
That was not, but the uranium space still has a lot of juniors that are cheap, but you got to be careful. I would recommend with the juniors an ETF because with juniors, you might have, say you have 10 stocks. You might have 3 or 4 that go up 6, 7, 800%. But you're going to have 1 or 2 that go to 0 because in the junior space, you just naturally have some bad management teams and some potential accounting issues. So that's where the junior miners and an ETF might be a better idea.
There's a Sprott Junior Mining ETF, URNJ, that people could potentially check out. It's done well from the lows of April. Okay, that's kind of our mining questions. We do have a little bit more high-level questions. We actually got one on Tesla. And so you beat up on Nvidia, you beat up on Meta, and I'm so curious because you study people as much as you study markets. Like the question is, has Tesla ever made sense to you as a stock, as an investment?
Well, to me, Tesla in 2021, remember, Tesla's like, what is it, like 30% off of those highs, 25% off the 2021 highs? Peter Lynch, when I met him in Boston years ago, he said, Larry, the stock I want to stay away from the most is the hottest stock in the hottest sector. No one can make money in the hottest stock in the hottest sector because everyone's bullish on the same thing. It's very difficult to make money. Nvidia has kind of broken that riddle in recent years. Everyone's kind of made money on it. But at the end of the day, Tesla's stock has gone nowhere since 2021. That's 4 years with gold up, 80% probably. And it's actually down.
It's a lot of volatility in between. You could have made a bunch if you caught it at the right time. But you're right. Yeah, from peak to peak, 2021 to today, you're kind of flat. You're down like 14%.
Yes. And so I think, this is very telling, Amber, about the Mag 7. The Mag 7 in 2023, 24, they were all going up together pretty much. Now you're seeing Apple's down 4% since just December. Amazon's about flat. And then you have this Tesla problem. I think Tesla, listen, I think battery technology, that is a really sexy part of electric vehicles, about, home powering, the home. And so Tesla and autonomous vehicles, I'd much rather own Tesla than many of the Mag 7 companies now, if I had to choose.
Why?
Because, well, first of all, I know valuation, it's not, if you look at the stock price, it's down, but it's not cheap, right? It's not cheap. People say that Nvidia is actually a lot cheaper than Tesla. I just think that, Musk has been too focused on politics. He's going to focus back on Tesla. And like I said, that battery technology and autonomous vehicles, he's going to be right in the hotspot of some sexy growth plays in the next coming years. And I just think that everyone's really, too many investors, just look at Nvidia. Nvidia's like, what, $4 trillion, right? And Tesla is a fraction of that.
All right, that's interesting. I feel like that's a contrarian play for a guy who doesn't like the Mag 7 that much. We have 2 more kind of high-level questions before we get into your top ideas. One kind of puts a bow on everything we talked about from a macro perspective. This one coming from Adam. You've warned in the past about debt bubbles, systemic risk. As we head into September, what's the single biggest risk you see in the global markets right now? U.S. government debt, China slowdown, something else investors aren't paying attention to?
Yeah, the big thing is the global backdrop around sovereign yields. So the U.S. 30 years gone from about 5% down to like maybe 4.7. So that's good. But all the rest of the yields in the world of the G7, G10 countries are pretty much all breaking out near all-time highs. And so that will really put a lot of stress on financial institutions if you get a really big move there. And this situation in France, the falling of the government, you could have, I think, the probability that you have a failure of the UK government and the French government in the next year is very high. And that would put even more pressure on global yields. So the thing that people aren't focused on are global yields. And that's a lot of money. There's a lot of money in global bonds, right? And so that's another potentially very bullish thing for hard assets, but potentially dangerous for the banking system.
By the time this comes out, we would have the results of the no confidence vote in France, but as of this recording, we don't. But basically, it's happening in part because the fiscal situation in France is in shambles, and it's been years. It's been more than a decade since I've thought about the fiscal situation in Europe, right? In 2011, that's kind of all we're talking about. And you mentioned the UK. Where is it ranked right now? The European credit situation, and what do investors, if you're mainly a North American investor, need to know or think about?
Well, the first thing you want to look at is credit default swaps and say SocGen, which is the big French bank. But there'll be a workout situation. If you look at the probability, like on the betting sites, it's it's almost 100%. So the market's expecting the government to fall. It won't be unexpected. But then, what do they do around policies? And this all goes back to my book, right? Large governments, um, every democracy in the history of the world, most democracies, there's a cycle that we talk about in our book, How to Listen to Market Speak. And at the end of the day, when politicians are really forced to raid the public treasury by the voters, it creates up an unsustainable situation. And unless central banks are in there buying the bonds, which they're not right now, um, that really gets you higher and higher bond yields. And that's why if you look at the life cycle of democracies, they really only last 250 years or so because of that kind of, just look what happened in Argentina, right? You finally, you had a government that defaulted a number of times, right? And so those types of cycles just keep repeating themselves because politicians are enabled by the voters to kind of raid the public treasury.
Okay, let's get into your pro picks now, your best ideas in this market. ProPix is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so you've brought your three best ideas. To recap, you are somebody who looks for areas of risk. Right now, you say the best play is to move into hard assets and tech is poised to underperform. Yeah. So is it any wonder that your first idea essentially is to short Nvidia? And you can do this through a product. It's an ETF that shorts Nvidia for you and puts on some leverage. So if Nvidia were to fall, you wouldn't just capture that downside. You could potentially capture more than that. Is that a good way of explaining it, Larry?
Well, yeah. Remember, this is kind of like more entertainment than all because, I mean, levered ETFs are dangerous and they have an embedded decay, right? So if you buy a levered ETF, and say you put whatever it is, $100,000 into a levered ETF and the stock goes nowhere for a year, you're going to be down probably 9 or 10% just by the decay of resetting the portfolio. So it's a very dangerous situation to be long, say, a levered ETF. But the point we're trying to make is the energy bottleneck situation. And so what we're seeing is clients that are actually getting long some energy plays and short Nvidia against it, because the energy bottleneck situation is so profound, the probability of that happening, that it sets up a big risk to Nvidia. You got 28 times sales. Just think of Microsoft, right? And think of Apple. And so once you get above, say, $2 trillion, $3 trillion company, Apple's trading at 8 times sales, Microsoft 13 times sales. You can't have a 28 times sales company at $4 trillion. It's very difficult to make money at 28 times sales when the other Mag 7 companies are all trading at either 8 to 14 times sales. You just need a perfect execution path. And then if you look at the Avago news from last week, the moat. Now, the big argument around Nvidia is their impenetrable moat, right? And if you listen to anybody from Harvard Business School, they'll tell you about, that moat. And all that is setting up kind of barriers to entry, monopolistic type power, allows, tremendous profits. But it's pretty clear that Nvidia's moat is cracking. And it's also pretty clear that the probability of bottlenecks in the energy space to support artificial intelligence growth and all those data centers, that's also coming in very, very fast against Nvidia. And so at the end of the day, yeah, we're short Nvidia.
Yeah, I'm glad that you said that about that ETF, because I was going to beat up on you for buy. So it's really just an illustration, short Nvidia and maybe against a long, and we'll talk about that in your second pick. But I want to go back to this idea of Nvidia does fall, and sometimes it falls 30% over the course of a year, and sometimes it falls, as much as 60%. Nobody had a nice time in 2022, Nvidia included. But if you're a long-term shareholder, not even long-term, in 2 years, the stock's up 1,000%. How do you recommend a short like that when you find there are cracks, but Nvidia is really the only game in town?
Yeah, so I just look at, like we talked about earlier, the thing about Bitcoin and say Michael Saylor and that whole crap, they've destroyed a lot of investors, because at the end of the day, since 2017, you've had 4 drawdowns of 80%, 80%, 4 of them, right? And like I said, the average person, you see all these jerks on Twitter holding up these long-term track records. It's complete garbage. At the end of the day, what happens is, like I said, a young couple, they're building a house. They've got some money invested in the market. All of a sudden, they're down 50, 60, 70% for 2-3 years with, say, Bitcoin that was down there for 2, 3, 4 years. They just don't buy and hold. It's very difficult. Look at gold. Gold's biggest drawdown in the last 10 years, gold's biggest drawdown, 22%. That is a preservation. That is a store of value. Only 22%. Whereas the biggest drawdowns for Nvidia and Bitcoin are in that 70 to 80% bucket.
So you mentioned, maybe short Nvidia, go long energy. And one of the areas of energy you're going long right now is natural gas. You're expressing that through, there's so many equities that you could look at: Long Range Resource Corp, Antero Resource Corp, First Trust, natural gas ETF. Let's talk about the thesis. Why natural gas?
Okay, first of all, Amber, one of the things we love is when you have a sector where you kind of have what we call a hot money flush just occurred. And what we mean by that is, if you talk to investors around the country, we talk to a lot of institutional investors in our Bloomberg chat behind us. And remember, that's what our book's all about: how to listen to markets speak. It's about gathering the intelligence from great investors. We sit down with David Tepper. We sat down with David Einhorn in the book, Charlie Munger. So we're constantly looking at the large investors and what they're talking about, and successful investors. In the natural gas space, the big consultants this year were talking about a very, very hot summer in the Northeast. And anybody that was up on Cape Cod or New York or Boston this summer, how cool it was relative to previous years. And so natural gas itself was really, a lot of people try to front run that that expected hot summer because of all that air conditioning demand. And so you had a big move up and in a real nasty, what we call a hot money flush. So the natural gas equities like Antero and Range Resources are essentially down 35% off of those spring highs. And these companies are buying back stock at the fastest pace in the history of these companies. So there's a real bid in there under the surface. And they're trading at what we call 10 to 15% free cash flow yields. That all that means is they're producing so much cash flow, they're buying back the stock. They can do a lot of things with that stock to that cash flow to support the equity price. And you've just got great valuations trading at 2 to 3.5, maybe 4 times EBITDA. And so great valuations, but also look at Meta, look at the hyperscalers. The only path to the green meadow, and that's what we call solar and wind, the only sustainable path to support artificial intelligence to get to that green meadow, which is way out in the future because we're just nowhere near our artificial intelligence being supported by wind and solar. The only path is through natural gas. So I love I love a sector where you've got great valuations. The companies are reducing debt, strongest balance sheets in years, great valuations, but they're also on the precipice of an incredible bull market powered by natural gas demand from artificial intelligence.
So again, I asked the question, do you want to hold natural gas through that ETF or do you want to own the equities? The equities at least have a better longer term track record, and nat gas, like it's really cyclical.
Yes, well, one of the problems with the natural gas ETFs like the UNG is they constantly are rolling the contracts. So say you run the UNG ETF, which is the natural gas ETF. They have to roll the future. So this month's future expires, they buy the next one. There's a cost to that over time, and it can get pretty costly. The FCG ETF, Frank Charlie George, is long a basket of natural gas companies and pipelines. What's fascinating about the FCG ETF, Amber, the top 3 holdings in the FCG are only worth $250, $270 billion, top 3 names. That is a fraction of Nvidia. Nvidia's wants to get 4.1 trillion. So you can buy the FCG ETF. All the stocks in there combined are a fraction of Nvidia's valuation. It's a great buy.
Your third one is pretty interesting. It's coal. I don't know the last time I've had somebody come on and say, look at coal, because isn't that a dying energy source?
Yes, it is. But what we've noticed is over the years, there's been 3 or 4 times where coal was carted out. Remember, the coal ETF, KOL, it got so bad for coal that that ETF had to shut down.
Yeah.
So we have had many periods in time, but the coal names in recent years have been with multiple periods where they're destroying tech. Not this year, but the coal names are a great value. CNR equity trading at 3 times EBITDA, great free cash flow yield. It's the old Arch Coal, and remember, Arch Coal. You've got met coal, which is for steel, and then you have coal that's producing power for the plants, right? And so artificial intelligence, the demand on power is going to be so great. It's going to be explosively supportive of coal. There's just no way of getting around coal. There's no way. And so we love the valuation. And we also like the fact that a lot of the hot money came in on the Trump win in November. Look at CNR equity, Charlie, Nancy, Robert. Or just look at the new coal ETF, the COAL. We were really hammered here because a lot of people bought the coal names into the Trump win, thinking, Trump, what's he call it? He calls it big beautiful coal, right? So you have a very supportive White House. You've got a sector that's been hammered, trading at amazing valuations. Once again, into that artificial demand for energy, and so that's just another great way to play artificial intelligence. Every Tom, Dick, and Harry is in Nvidia and Meta and Microsoft. Any moron knows that's an AI investment. Nobody's doing the math on the real best risk reward in artificial intelligence, and that's the power sector.
All right. I love it. Coal is the AI trade. Larry, always fascinating to get your perspective. Thank you so much for taking the time and joining us this hour.
Thank you, Amber. And don't forget how to listen to markets speak.
Yeah, we've got it up, and you can see the link as well in our show notes. Give it a read because it really is. We love those long pieces on how to think about investing. These shows obviously are great too, but do your homework. And these books, like Larry's, are absolutely must read. And I loved it too when I read it. Thank you so much. That's Larry McDonald joining us from the Bear Traps Report. This is ETF Minute, and today we're talking about the world of covered calls. Now, a lot of people like these strategies when it comes to ETFs because it creates income or generates income. But how does it actually work? When is it appropriate? For that, let's bring in George Lagoudakis, who is the VP Portfolio Manager in Capital Markets at CI Global Asset Management. Thanks so much for joining me, George.
Thanks for having me.
Let's start with the basics. What is a covered call?
A covered call is a portfolio of securities that you own, but you're selling options, typically short-dated, to generate premium but cap the upside on a percentage of the portfolio.
And how should investors think about the market environment in which using covered calls is the most advantageous?
I think you could argue it's advantageous in all environments if you're looking for the best risk-adjusted returns. But generally speaking, flat markets benefit as you keep the premiums and aren't getting exercised on the options. In a down market, you'll likely outperform as well. In a slightly up market, you can also outperform. That's probably actually the Goldilocks scenario, but it's in the raging, bull market going up, a lot every month where you're going to underperform.
Doesn't that feel like the kind of market we're in right now? I mean, how do you apply covered calls in today's environment?
Yeah, I think today they're even more important because inflation is high and it's likely to stay above trend, in my opinion, and lead to a stagflationary environment. And volatility, I think, is also going to be higher than we've seen the last decade. So those are both going to benefit tax advantage income, which these products provide, and monetizing that higher volatility.
How active do you have to be when you're using these strategies in an ETF?
Yeah, you can be active, but I think it's more important to be systematic and in liquid securities because, again, options are volatile and trading them every day. They're wider spreads. They move quickly. So execution is very important in this space.
Let's use examples to kind of illustrate this. We'll talk about two markets right now. First, let's start with tech. So you've got this covered call strategy in tech. The ticker is TXF, the CI Tech Giants Covered Call ETF. So raging bull market in tech. What do covered calls do for an investor in tech?
Yeah, I think it could allow you to switch over to a portfolio that's now going to give some cushion to the downside, and it's going to allow you to create a payment because the technology sector typically doesn't pay dividends or they're very low, but this lets you monetize their higher volatility because the tech sector generally has higher than average volatility. So you can create a solid income stream off that. So I think it's quite suitable.
And what about gold? Because you mentioned gold, which has already run up so much, but the bullion seems to be like kind of consolidating at these levels. How do you think about what covered calls do in commodities, in the mining sector? Gold, for example, you've got that CI Gold Plus Giants Covered Call ETF.
Yeah, I think the commodity sector makes a really good case for these products. The gold sector is one of the only sectors where volatility rises with price. And these sectors tend to be more volatile. So I think people stay in the sector longer when you've reduced volatility by selling the volatility and selling the options. It's gone up a lot this year so far, but the miners themselves are still trading at a discount historically versus how much money they're making. So their cost versus where gold is or the price of silver. And if you look at positioning the futures market or ETF holdings of physical gold, they're nowhere near their all-time highs. So there's room to run, I think.
So do you have these strategies in only select sectors, or could you do covered calls on any sector?
You could do it on any sector. We cover all the major sectors in North America, and we have a product as well that owns the basket of those, like a multi-sector.
George, thank you so much for joining us with these insights.
Thank you for having me.
That's George Lagoudakis joining us from CI Global Asset Management. If you're interested in learning more about these ETFs, go to the link in the show notes. Make sure you tune into our next episode. We've got Adam Waterous on the show of Strathcona, and Strathcona just increased its bid for MEG Energy. Is it going to come away with MEG? Well, we'll get perspective from Adam Waterous, why he ultimately increased his bid, what it means for the special dividend that he promised if they didn't get MEG Energy. So make sure you tune in. That episode coming out Thursday at 6 a.m. Eastern Time. We'll see you then.